4.5%. That is the inflation rate Oxford Economics now says is coming for the United States if Iranian forces close the Strait of Hormuz and Brent crude hits $130 per barrel. Not in some distant future scenario, right now, today, because the war has already started. Iranian forces have struck 27 American military installations across the Middle East. Israeli targets in Tel Aviv are burning. The Strait of Hormuz, the narrow choke point through which 20% of the entire world's oil supply flows every single day, is now an active combat zone. And the Federal Reserve, which was already trapped before the first missile was fired, has just had the door to any possible rate cut welded permanently shut. This is not a financial risk. This is a financial sentence. Being carried out right now, while the news cycle focuses on the war itself rather than the economic catastrophe that war is detonating in slow motion underneath your feet. The chain reaction has already started, and most people have no idea what is coming for their savings, their mortgage, their grocery bills, and their retirement accounts. To understand why 4.5% inflation is not just a number, but a financial execution order for the American middle class, you have to understand what was already happening before Iran fired a single missile. The Federal Reserve was already in the most dangerous trap in its modern history. Core Producer Price Index, the measure of inflation in the production pipeline before it ever reaches consumers, came in at 0.8% in February of 2026. That number was 2.7 times higher than economist forecasts. Not slightly elevated, not a mild surprise. 2.7 times higher than what the most sophisticated models on Wall Street predicted. When the smartest analysts in the world miss by a factor of 2.7, the system is behaving in ways they cannot model, cannot predict, and cannot control. Personal consumption expenditures, the Federal Reserve's own preferred inflation gauge, is running at 3%. The Fed's official target is 2%. They are 50% above their stated mandate right now, today, before a single barrel of oil is disrupted by the conflict in the Persian Gulf. And then there is what traders are calling the Warsh shock. Kevin Warsh, the former Federal Reserve governor, delivered a warning months before the Iranian strikes that sent the bond market into convulsions. He argued that investors were fundamentally mispricing structural inflation risk in the American economy. The term premium, the compensation demanded for lending long-term to the United States government, had collapsed to levels completely inconsistent with fiscal reality. The bond market listened. Treasury yields spiked. Mortgage rates climbed. The cost of money became materially more expensive at the exact moment the consumer could least afford it. That was the landscape before Iran launched its strikes. A Federal Reserve with no room to move. Inflation already running hot. The bond market already shaken. And now add a war in the world's most critical oil choke point on top of all of it. Before we break down exactly how the Hormuz crisis transforms this already impossible situation into a full-blown economic catastrophe, and how you can protect yourself from what is coming, please make sure you are subscribed to the channel so you do not miss the daily updates on this developing crisis. And comment below right now. Fed rate cuts in 2026, yes or no? Let us see what this community believes. The Strait of Hormuz is 21 miles wide at its narrowest navigable point. Through that choke point passes approximately 21 million barrels of oil every single day. Global consumption runs at 100 million barrels per day. One geographic bottleneck, now an active war zone, controls 1/5 of the entire world's daily energy supply. There is no pipeline bypass that can replace this volume. There is no alternative maritime route with this throughput capacity. The Strait of Hormuz is the jugular vein of the global economy, and it has just been cut. Oxford Economics modeled what happens when Brent crude reaches $130 per barrel, where most analysts believe oil would go if the strait is even partially disrupted. U.S. inflation accelerates to 4.5%. Eurozone inflation hits 4%. That is the conservative scenario. Capital Economics calculated that even at $100 per barrel, global inflation would accelerate by 0.6 to 0.7 percentage points across every major economy simultaneously. This is not a regional problem. An oil shock of this magnitude hits every supply chain on Earth at once, because petroleum is the foundation of transportation, agriculture, chemicals, and manufacturing everywhere. Now here is where the trap closes. The Federal Reserve has one tool for fighting inflation: raising interest rates. When prices surge, the Fed raises rates to cool demand. That is the theory. But the Fed is already operating in an environment where current rate levels are causing severe stress in commercial real estate, in regional banks, and in household debt markets. Raising rates further risks crashing the housing market and triggering the recession the Fed has spent years trying to prevent. But cutting rates while inflation is at 3% and heading toward 4.5% is monetary malpractice. The futures market had been pricing in 2 to 3 rate cuts during 2026 just weeks ago. Those expectations are being eliminated in real time as the missile counts rise. The technical term for what the Federal Reserve now faces is a stagflation trap. Simultaneous high inflation and economic stagnation. The Fed's tools work on one problem at a time. Cut rates to fight recession and inflation explodes. Raise rates to fight inflation and the recession deepens. The central bank becomes paralyzed. The last time the United States faced true stagflation was the 1970s, and it took Paul Volcker raising rates to 20%, plus a decade of economic devastation to escape. That was before the United States had $40 trillion in national debt, before commercial real estate was sitting on $2 trillion in refinancing risk, and before regional banks were carrying $600 billion in unrealized securities losses. But the story does not stop with the Federal Reserve. The oil shock does not travel in a straight line from oil well to gas pump. It radiates through every layer of the economy simultaneously, creating a cascade of compounding shocks. The first layer is gasoline. When Brent hits $130 per barrel, Americans pay between $5 and $6 per gallon. For a median family with 2 vehicles, that is approximately $2,000 in additional annual fuel costs. Not an economic abstraction. Money pulled directly from grocery budgets, medical co-pays, and whatever emergency savings remain. But the story does not stop there. The second layer is food. Petroleum is the raw material for synthetic fertilizers. It fuels every tractor, combine harvester, and refrigerated truck that moves food from farm to supermarket. When oil spikes, food prices follow with a lag of 60 to 90 days. Agricultural economists estimate that sustained oil at $150 adds 15 to 25% to grocery bills within 2 quarters. For a family spending $800 a month on food, that is an additional $1,400 to $2,400 per year. Added to the fuel costs, total household impact reaches $4,000 to $5,000 annually. Against wage growth running at 3 to 4%, this is a real wage cut for most working American families. But here is where it gets worse. The third layer is energy infrastructure. The U.S. power grid relies on natural gas for approximately 40% of its electricity generation. Natural gas prices track oil prices in a crisis. As oil spikes, utilities pass higher input costs to residential customers. The Energy Information Administration estimates that oil above $130 would push residential electricity rates up 15 to 20%. This hits working-class families hardest because energy spending as a share of income is highest in lower income brackets. But the real danger lies one layer deeper. The fourth layer is the commercial real estate debt catastrophe. United States commercial real estate faces approximately $2 trillion in loan maturities during 2025 and 2026. These loans were written when properties generated enough revenue to service low-rate debt. After the pandemic destroyed occupancy rates and interest rates climbed, the same properties cannot service their debt at current rates. Banks have been using a strategy insiders call extend and pretend, a dangerous game of delay where lenders allow borrowers to roll over maturing loans, gambling that rates eventually come down to make the math viable again. That entire strategy was premised on the Federal Reserve cutting rates. That premise is now eliminated. Loans being quietly rolled over will be forced onto balance sheets as losses. Combined with $600 billion in unrealized securities losses already sitting on bank books, the banking sector's vulnerability has not been this acute since 2008. And this brings us to the most terrifying part. The fifth layer is the bond market itself. Foreign central banks, led by China but followed by Japan, Saudi Arabia, and dozens of de-dollarizing nations, have been reducing their purchases of U.S. Treasury bonds. The U.S. government runs a $2 trillion annual deficit and needs constant bond buyers. When foreign buyers reduce participation, the government must offer higher yields to attract domestic capital. Higher Treasury yields raise borrowing costs across every loan in the economy: mortgages, corporate bonds, auto loans. The oil shock accelerates this dynamic specifically. Countries that import oil, meaning nearly every nation on Earth, must spend more of their currency reserves purchasing energy. They have less reserve capital to recycle into treasury auctions. They become net sellers of dollar assets to fund energy imports. This accelerates foreign selling of treasuries at the precise moment the U.S. government needs more buyers, not fewer. A self-reinforcing spiral of higher yields, higher borrowing costs, and tightening financial conditions that no Federal Reserve action can meaningfully offset. But there is a sixth front opening in this war. The seventh layer is the geopolitical risk premium embedded in every global financial transaction. When a conflict involving Iran erupts in the Persian Gulf with U.S. forces directly involved, it does not just affect oil. It expands risk premiums across every dollar-denominated asset. Credit spreads widen. Maritime insurance explodes. Lloyd's has already begun recalculating premiums for vessels transiting the Gulf. Every additional escalation, more strikes, new actors entering the conflict, infrastructure targeting, gets priced into markets with mechanical immediacy. All of it points in the same direction: higher prices, higher volatility, deeper compression of consumer and business confidence. Let us bring this from geopolitical abstraction to the specific reality of your household. If you carry a variable rate mortgage or any adjustable rate loan, your monthly payment is about to increase. If you were counting on refinancing at lower rates in 2026, understand clearly. That plan is canceled. The rate relief you were waiting for is not coming. You need to rebuild your budget around current rates as a permanent baseline. If your retirement account follows a traditional 60% stocks and 40% bonds allocation, understand the structural problem. The 60-40 model was designed for a world where bonds rise when stocks fall. In a stagflation environment, Both fall simultaneously. Inflation destroys bond values. Energy cost destruction crushes corporate earnings and stock valuations. Your retirement savings face losses on both sides with nothing to offset. We saw the early version of this in 2022. A true stagflation scenario produces a far more severe version. Your bank account is not a protective vault. It is a position in the United States dollar, which is simultaneously under pressure from inflation, from the oil shock adding momentum, from foreign central banks reducing dollar demand, and from a government spending $2 trillion more per year than it collects. Every dollar in a savings account is losing real purchasing power daily. The interest you earn likely does not cover the actual inflation rate you experience for your specific spending basket. Your real savings balance is declining every month. You are paying the fuel premium. You are paying the food inflation premium. You are paying the geopolitical risk premium embedded in borrowing costs. You are paying the fiscal deficit premium from a government borrowing at unprecedented scale. You are paying all four simultaneously, whether you register it or not, in prices rising faster than your wages, and in financial opportunities contracting as capital becomes more expensive. The window to take protective action is narrow and closing. Here is what financial history teaches us without exception. Serious dislocations do not arrive with advance warning and adequate preparation time. They build quietly through the accumulation of vulnerabilities that most people dismiss. And then they materialize suddenly, at a speed that does not permit orderly repositioning by those who waited for official confirmation. Every element of the scenario described in this video is active and measurable today. The oil shock is underway. The Fed is frozen. The bond market is under pressure. Commercial real estate is approaching a recognition event. And the banking system is carrying losses that have not yet been forced onto balance sheets. The Dodd-Frank Act contains provisions that most Americans have never read. These provisions are known as bail-in procedures. If a bank reaches insolvency, the preferred resolution mechanism is no longer a taxpayer-funded bailout. It is the forced conversion of uninsured depositor accounts, any balance above the $250,000 FDIC threshold, into bank equity. Your deposits become worthless bank stock. This is not a theory. It is the law of the United States. The FDIC insurance fund contains approximately $125 billion. Total insured deposits in the American banking system are approximately $10 trillion. The fund covers 1.2% of what it is meant to protect. In a scenario involving multiple simultaneous bank failures, not impossible given $600 billion in unrealized securities losses plus $2 trillion in commercial real estate impairment, the fund is depleted rapidly. The FDIC faces a choice between emergency congressional authorization or acknowledging publicly that the guarantee cannot be honored in full. Neither option prevents a panic. Neither option comes with 60 days' notice to allow you to move your money. Capital controls have been imposed in developed economies within living memory. Cyprus in 2013, Greece in 2015. In both cases, controls arrived with minimal advance notice. Citizens who had already repositioned were protected. Citizens who waited for the official announcement were trapped. By the time any official source confirms publicly that extraordinary measures are under consideration, the window for action is already closed. Do not be the last person standing outside a bank branch when the announcement comes. The question is no longer whether this crisis is real. The data from Oxford Economics, Capital Economics, the FDIC, Federal Reserve disclosures, and real-time market pricing across oil and treasury yields confirms it. The question is what concrete action you take right now. First, audit your bank deposit exposure immediately. If you hold deposits at any single institution exceeding $250,000, you are above the FDIC protection threshold. Distribute across multiple separate institutions, keeping each account below the insured limit. This takes an afternoon and eliminates your bail-in exposure for balances above the threshold. Second, examine your bank's commercial real estate risk. Regulatory filings for every FDIC-supervised institution are publicly accessible through the FDIC website. A commercial real estate to capital ratio exceeding 300% is the threshold regulators identify as elevated risk. If your primary bank is above that level, consider transitioning core accounts to a major systemically important institution or a credit union with conservative lending practices. Third, establish a physical metals allocation outside the financial system. Not exchange-traded funds, not paper claims. Physical gold and silver held in your possession or in an allocated storage facility where your specific holdings are legally segregated. In a system stress scenario, the paper price and the physical price of metals diverge. Premiums for actual physical metal explode as investors discover the quoted spot price does not reflect real-world availability. Establish this position before that divergence occurs. Fourth, eliminate variable rate debt on an accelerated timeline. Variable rate credit card balances, adjustable rate mortgages, floating rate loans, all of these automatically increase your monthly costs when rates remain elevated or rise further. Each variable rate account you eliminate removes one transmission mechanism through which this crisis damages your monthly budget. Fifth, evaluate Treasury Direct for your liquid cash holdings. Treasury bills purchased directly through the United States Treasury's own platform offer yields competitive with high-yield bank savings products, while eliminating bank counterparty risk entirely. Your Treasury Direct holdings are direct government obligations registered in your name, not held in a bank's inventory, not subject to bail-in procedures. In a banking system stress event, these holdings are fully insulated from any bank-specific failure. We are at an inflection point that arrives once in a generation. The Iran war has not ended. The conflict is active and escalating. The oil shock has not peaked. The Federal Reserve is frozen and cannot move to rescue either the economy or the financial markets without detonating the inflation crisis. The 4.5% inflation projection from Oxford Economics is the conservative estimate, premised on a partial and brief disruption. Goldman Sachs and JP Morgan have published internal scenario analyses in which sustained conflict pushes Brent to $170 to $200 per barrel. At those levels, the impact approximates the 1973 oil embargo shock that delivered stagflation, double-digit rates, and a decade of stagnation to the American middle class. The critical difference between 2026 and 1973 is that the United States enters this crisis with $40 trillion in national debt, a Federal Reserve balance sheet never fully normalized after the pandemic expansion, a commercial real estate sector approaching catastrophic loss recognition, and a banking system more concentrated and more leveraged than at any point in the modern era. The 1973 shock hit a relatively sound system. This one is hitting a system already compromised before the first missile was launched. The chain reaction is not a forecast. It is a process already in motion. War in the Persian Gulf, oil accelerating toward $130 and beyond, inflation building toward 4.5%, Federal Reserve paralyzed between its inflation mandate and financial stability obligations. Bond market under compounding pressure from foreign selling and domestic fiscal deficits. Regional banks facing simultaneous deterioration across their securities portfolios and commercial real estate books. Corporate earnings crushed by energy costs. Household budgets under assault from every direction simultaneously. This is not one crisis with one cause and one solution. It is a chain reaction that feeds itself. Each link activates the next with mechanical precision. And it is running right now, today. Subscribe to the channel and turn on the notification bell so you receive immediate alerts as this situation develops. We are tracking every dimension of this crisis daily. Oil prices, Fed communications, Treasury auction results, bank regulatory filings, and the military situation in the Gulf. The next 12 weeks will determine the trajectory of the American economy for the next decade. Share this video with everyone you know who holds savings in a bank, carries a mortgage, has a retirement account, or earns their living in an industry exposed to energy prices. The algorithm does not favor content that makes people uncomfortable with difficult financial realities. The distribution of this information depends entirely on this community. Share it because the people who need it most are the least likely to find it on their own. Together, we can navigate what is coming and emerge with our wealth, our security, and our freedom intact.